publishing this on BuzzFeed because they'll publish anything. This is all about international investing. It's a little bit about Centersone. I do want to just give you a little bit of background before just to frame my comments. We are value investors. We're global investors. If you're familiar with my old firm, First Investment Management, we're also value investors. So as we're talking about long-term value and global investing, and if I'm talking about international investing, I should say, consider that's in the framework of me being a long-term global value investor. The name of the firm is Centersone Investors, so that's your clue. It's about long-term frame reference, frame of mind. The kind of the genesis for our approach, really starts with Ben Graham and a book he wrote called The Intelligent Investor years ago in the 40s. This book is considered the Bible of value investing, but I'll point you to the fact that the Bible of value investing is called Intelligent Investor, not Value Investor. It's a knock, or it's just meant to alert you to the fact that it's about thoughtful, intelligent framework, but it's also about investing. Investing is a long-term endeavor. So everything that we've done has been all about investing and not speculating. In his book, Intelligent Investor, Graham does not distinguish between value and growth. He distinguishes between investing and speculating, which is partially a time horizon related thing. One that is more related also to just the amount of information that you have in order to make a decision. Again, investing is more thoughtful. So that's Centerstone in a nutshell, and value investors as a group in a nutshell. We're slightly different than other, because that's speech-based trading value guys can tell you. We're a little bit different from other value people though, because our primary emphasis is on risk mitigation, loss mitigation. So what we're trying to do is invest in companies that have good return potential, obviously, but that have minimal chance of suffering an impairment in terms of their business or in terms of the value we pay for their business. So we tend to be even kind of more cautious and conservative, even in the spectrum of international and value investing. So why international? I'll keep this relatively brief and then open up for questions. But why international? First of all, there's greater choice internationally, obviously. Of companies that are greater than $1 billion in market cap, there are 8,300 total globally. And 6,000 of those, 6 out of 8,000, are domiciled outside the United States. So clearly there's more choice. But even within that, there's a lot of overlap within industries across geographies. So for instance, for every Hershey, there's a Nestle. For every Pfizer or Merck, there's a Novartis or a Roche. For every GM, there's a Toyota. For every Shell, Total, BP, there's an Exxon. You get the point. Why I've never thought of it rational to pigeonhole yourself in one country when so much of the world, after decades of globalization, is cross-comparable. So many of these companies are. Sometimes overseas you get better choices than you would in the United States. So FANUC, I own this company called FANUC in the Centerstone funds. This is a Japanese industrial company. 98% of the cars you see out there that were manufactured in the United States anyway use a FANUC robot to paint the car. 98%. So this is a huge company that many people really not heard of anymore as much as they should have. Very significant market share around the world. It's Japanese though. This high-quality Japanese company competes with companies that are based in Germany, Taiwan, China, United States, but it's the best among them all. And so, we never understood why you should just, exclude that part of the world when your ultimate goal is to have a portfolio of high-quality companies. That said, sometimes the choice is worse. During bubbles, whether it's the late 90s bubble or the financial crisis, or leading up to the financial crisis, some of the worst companies will be based outside the United States. I remember years ago, it was February of 2000, right at the peak of the internet bubble. So I'm going way back, but I was in Asia at this conference, and this is in Hong Kong, and even back then I just couldn't find anything to buy. Everybody's, obviously, this is the bubble. But I went to go see a a presentation, and it was sort of like the Google, the emerging Google of Singapore. They were trying to create the search engine, and he was making a presentation, and the CEO was very young. He looked like he was, I mean, maybe he just busted through his 20s. And somebody asked him kind of like hard questions. I mean, it wasn't hard in hindsight. It was kind of like, how are you going to make money? And this guy, older guy, stood up in the audience and starts berating the questioner. And it turns out that's his father, the CEO's father. So like, I think that was the kind of stuff that people were willing to, entertain back then. And so just because you have more choice doesn't mean that you have better choice. But in many cases, it's good to have, the breadth of choices available to you. Inside the United States also, it is important to understand that cultural differences, tax differences can influence how management teams deal with the capital that they have on the balance sheet, or the cash flow that they generate every year. So in certain countries like Great Britain, Hong Kong, a lot of the Commonwealth nations have a very dividend-friendly tax code. It encourages companies to pay out as much in tax dividends as possible, but it also discourages them from really investing as much as they should in the assets that they have, because they're trying to generate cash flow to pay dividends. So it's important to understand, sometimes a company in some country might have a very high dividend yield. That doesn't necessarily mean that it's cheap. It just means that they're paying all their earnings out in dividends. So it's good to have a specialist, I guess, like me or this gentleman here who's doing international investing, understand those cultural differences to kind of navigate you through all these differences. So anyway, so one reason I think in my mind, the most obvious reason is there's greater choice internationally, so why close yourself off to international? More to the point of why international now, a few reasons. One, the international markets trade for lower multiples of earnings. On slide 5, you can see this is the price-earnings ratio of the S&P 500 on the foreign earnings versus the price of the PE ratio of the EFA index on foreign earnings. And what is this telling you? It's telling you that the S&P for the last 15 years has been trading for a premium to the EFA index on a price-earnings multiple basis. The premium in the beginning of 2000 was a 4-point premium. By 2002, it's basically even. By 2008-9, it was about the same. And we're currently at, again, about a 3-point premium of the S&P versus the E. So, you can make a case that just on a relative basis, international stocks are just simply cheaper than U.S. stocks. From the market's perspective, there are reasons for that. They will justify the earnings gap. The typical reason is that EFA, or international indexes, have lower quality of earnings than the S&P 500. They'll point to, for instance, the EFA has 25% invested in financials versus 15% for the S&P 500. Very importantly, the EFA has 5% in information technology. Microsoft's, Intel's, and Amazon's of the world. That's versus 5% in EFA, so there's basically no technology in the EFA index. And so those kind of gaps can convince, or have convinced the market that therefore the EFA index has lower quality of earnings and therefore should trade at lower multiple. Now I'll push back on that a little bit. Internationally, okay, so I'm not a big fan of leverage, so I don't really own a lot of banks. But where I do, they tend to be banks that have some sort of moat, and which is typically difficult to find in a commodity business. So one company I own is Bangkok Bank, in Thailand, obviously. And what makes this an interesting company is that, for one, it's one of 3 huge banks. The market shares tend to be very stable, which was a curiosity to me. And what we discovered was, doing the research, a very simple fact, which is that when a company banks with a bank, corporate bank, all of the payroll processing and checks must go to that bank. So every single employee has to have an account at Bangkok Bank. And so once you've established that corporate relationship, there's essentially no competition for the depositor. And so that creates a very static and stable market position for all these banks, and then that's the kind of thing I like. So that's high quality earnings, not low quality earnings. So I think in that case, the market's got it wrong. Within infotech, which is the biggest gap, so 5% in the EFA and 20% in the S&P 500, I would suggest that those are some of the lowest quality earnings that you can find, and partially because of the options, effective options issuance on the earnings stream. So for instance, I have here the stock options. So if you look at operating cash flow, so the amount of cash that's actually generated from the business before the investment facilities, options expense for Google is 19% of operating cash flow. After it's investing in the business, capital expenditures, it's a quarter of owners' earnings go to funding options programs within Google. The number is, well, Netflix doesn't make any money, but they report a net income. Options expense is 50% of their net income. Amazon, it's 18% of operating cash flow. Facebook, it's a quarter of the operating cash flow. So what is it you're buying here? You're buying a business that has already given contingent liability out to its employees, or an asset to the employees, that one day we'll find out what the actual cash flow expense really is. That to me is very low quality earnings. That's why we've had very low exposure to tech and growth companies over the years. So there's greater choice overseas. There's lower valuation, somewhat justified, and then somewhat, as I explained, somewhat not justified. And then away from this whole debate is, I haven't put it on here, but this will come out in a couple of months, is the idea of where international earnings actually are versus the trend. International stocks and earnings have had a tough go over the last 4 or 5 years. You can blame the commodity cycle, China retreating from sort of low value add manufacturing. The industrial cycle was on a downturn. On and on and on. And global trade has really tapered off over the last few years. It's impacted the earnings of non-U.S. companies quite dramatically. In 2007, the earnings for the EFA were 50% above what the trend or normalized earnings were. So you could make a case that the stock price, the EFA index price was high, and the multiple was high on elevated earnings. A double whammy there. Indeed, the next few years, the market fell by 50%. Here, now, today, the EFA's earnings are here, and the trend earnings are 50% above. So it's been a complete reversal of that. So if you step back, and I'll tell you what that means. It means that if that's true, you believe in normalization, reversion to the mean, that international indexes are trading for 10 times earnings, while the S&P 500 trades at 18 times earnings. That's a huge gap. That gap, the only time it's been bigger was 1998. So, which is about, the S&P traded at 8-point multiple to trend earnings back then as well. So there's another reason to kind of step back and say, okay, well, you could probably have, you may have two stages of return possibilities. One is the fact that the stock market, the international index is already cheaper than the U.S. And then that on earnings growth is potentially much more high in international indexes than in the U.S. We have a double discount. Earnings grow plus you get a premium contraction. So that's the first time since 1998 I've seen such a large gap. There are things that work against me. One is that earnings never recover, or they don't recover in a sufficient time to offset the time value waste. And of course, it could be that all stocks go down, just the international stocks go down less. That could be the worst way to resolve it. So we have greater choice overseas. We have lower valuations on stated numbers overseas. Earnings are way below trend outside of the United States. And then fourth, it's the cycle of international versus U.S. performance. This is on page 6. I do believe in reversion to the mean. I believe in a pendulum that kind of favors one or the other. It's just been the way the world works for as many decades without being able to research. But you can see, so I'm using on this page, slide 6, the equal weighted index for both the MSCI EAFE and the S&P 500. This is to correct for the two-tier market in 1999-2000. But you'll see that the stock market from 2000 to 2003, the EAFE went down 33% versus 18% on a weighted basis during the bubble. During the tech bust. That reversed from 2003 to 2007, the following bull market. The international markets went up 200%, 125% for the U.S. 07, 09, they both went down about 50%. And then this last bull market, the U.S. is up 250, while the EAFE is up 142%. This total return includes dividends. So the U.S. has gone up roughly twice as much as the international markets. And this is partly related to another factor, which is on the next page, which is number 7. The dollar cycle. So international investing and international value investing in particular is highly correlated with the dollar's strength. This probably is obvious to some of you, maybe not to most or some, but essentially, a weak dollar means higher earnings for foreign companies and vice versa. There are other things that happen to coincide with strong dollar, meaning at times lower commodity prices, which is worse for international versus U.S. companies. But the point I'm trying to make or share with you here is that if you go back to 1980 roughly, which is about when the dollar bottomed with Volcker, you had a near doubling of the dollar, or sorry, a 55% increase in the dollar, a near doubling of foreign currencies versus the German mark, but basically a 55% increase in the dollar. And then you had the closet pour and collapse, and then you had another trend up in the dollar from 95 to 2001, which is about 40% increase in the dollar versus foreign currencies on a trade-weighted basis. During that period of 2005 to 2001, international investing did very poorly. International value investing did poorly. Again, from 2011 until 2009, this has been the most, or 2017, this is the most recent dollar bull market, and the dollar's up about 35%. And predictably, international investing has been pretty pathetic. Last 3 years, the EAFE index is essentially flat. So what I'm getting at here is, if you believe in reversion to the mean, is that we're not at the beginning stages of an international down cycle. We're at the middle or maybe closer to the end. These are trend changes that last for multiple years, not 3 months, 6 months. And the timing is especially difficult in that sense because they are long trends, and you can be off by 6 months and look like an idiot, but that's not what we do at First at Centersone. We're international. We're long-term investors. I don't mind, as we are, kind of lagging right now a little bit. I don't mind it at all because we're going to hopefully capture the trend change later. So this is, kind of all macro top-down consideration because I'm not supposed to talk about the fund as much. So we're mostly bottom-up stock investors. Happy to answer any questions like that, but I just want to be careful not to spend too much time on funds and or educate you on where we might be, where's the pendulum as it swings back and forth from non-U.S. to U.S. investing. And I think we're close to the end, which is ironic because it's, as far as we know, it's the market's suggesting otherwise. So which brings to my mind also, when you're thinking about international investing, the other important consideration obviously is hedging, right? Currency hedging. I think I mentioned I think it was my mom heard me talking on TV once about hedging, and she was confused. She had something to do with gardening, And I think she's still not quite there yet. Yeah. She was like, so she invested in the fund, in the Centersone Investors Fund, and the first thing she does is specifically, before I invest a penny, you need to talk to your CFO. I need to ask him some questions about the fund. I said, well, I know the fund, I can answer the questions for you. She said, no, I want to talk to your CFO. So she talks to Phil, and Phil comes back to me, and he says, your mom wants to know if we invest in the NRA. I was like, what? You can't invest in the NRA, not that I know of. And she's like, well, no, she just doesn't want any exposure to gun-related companies. I said, well, okay. So I just ignored it. She did. And then, so the last thing is for, especially for more conservative international investors, what asset can you have to ensure to have some insurance just in case you're wrong about all this stuff? You know, and our kind of go-to has always been gold. So I don't own gold mining companies as much, but we do have a kind of place where we're stocking gold bullion. We've had in either the First Eagle funds are here for, going on 20 years. I think it's important to have some ballast and some insurance against currency debacle in any case. I bought, in 2009, I bought from the Bank of Zimbabwe. So Zimbabwe got this massive inflation, the worst ever. Just second worst ever, second only to the Hungarian crisis in the late after World War II. And it got so bad, the inflation got so bad that people were carrying around just bushels of cash just to buy like a loaf of bread. You had to go from, you had to take a lunch break and take your earnings from the half day to go straight to the grocery store to get your groceries because prices would have doubled by the end of the day had you not. And so it eventually kind of was getting to the point of, obviously that can't be sustained for long, and the government started printing out bills, $100 trillion bills. And to this day, it's a record holder for having the most number of zeros on a bill. And so as the central bank sort of blew up, they had gazillions of these things in their vaults, and they started selling them. So I bought 3 stacks of 100 each, $100 trillion notes. And they were $100 trillion at the time could buy 1 egg. That's what inflation can do. And that's how, and that's not the only example. Venezuela is going through it right now. GDP is down 10%. They claim inflation of 90%. My estimate is 500%, and it's 500% going logarithmic. Weimar Republic after World War I, Hungarian after World War II. You know what's going to happen. So it's just a matter of having some protection just in case. So that's why we never have all our eggs in one basket. I'm not always in equities or always in fixed income. We're always, certainly not always in gold or always in cash. It's a mix of assets that I found are, it's most likely to get you through whatever kind of scenario you face. So that's been our experience. Anyway, so why international? So there's a greater choice outside the United States. It's cheaper. It's potentially way cheaper if earnings are indeed that depressed. The performance cycle of international versus equity, I think that pendulum is getting towards that. At least it's not in the beginning, it's not in the middle, I think it's towards the end. And then finally, beyond all that is I think it's important to have some goal just in case. There are risks, obviously, of international, and I'll just wind up here. One is, there's less transparency, but it's improving. There's more self-dealing, so you have to worry about operators trading assets and whatnot, but their minority interest rules have really improved a lot. That's another word I think people used to get confused. I used to talk about minority interest investor rights, minority investor rights. And they didn't think of it the way like investors think of it. No, it's not because I'm Indian. But it's improving around the world to the point that I think some of the rules in the United States need to be revamped, particularly the squeeze-out rules. So that's kind of our case for international investing. And our funds were mostly, we have two funds. One's an investors fund, which is a global fund, and one is an international fund. The international fund is obviously international, but even in the global fund, we're way more exposed internationally than domestically compared to the typical sort of allocation fund in there. So we're practicing what we preach. And of course, what we do is because of what we're finding from the bottom up. We're finding more value overseas than in the United States. And I think it's also confirmed by this top-down sort of macro, it's not as macro, but the top-down look. So with that, if you have any questions, I'll be happy to answer.
Where in the world would you absolutely stay away from, and why right now? Which countries?
Syria.
Or do you invest in frontier?
Frontier. I have no opposition to it, but we're trying to invest. The typical company we like has a good balance sheet, has a good business model. That's a survivable business model, and that has a management team that we, they don't have to be the best in the world, but I just need to trust that they're going to take our money and run. That's a huge risk in most of these frontier markets. So, which means you need to be a specialist. You need to know the families. As close as we'll get to that is small cap companies in like Hong Kong or Singapore, things like that, where the exchange protections are so great that it sort of offsets our lack of knowledge. But we're typically more developed market. Our emerging market exposure is growing now because there's some value there, but we typically get it indirectly. Like a Nestle, we own Nestle. We have plenty of emerging market exposure there. We own Emerson Electric. It's 15% Chinese business. Fanuc, I mentioned Fanuc. It's a Japanese listed company, but they have more business in China than Japan. So we do get that exposure, but I'd rather have the benefit of it, which is the growth of underlying demand, consumption demand in these emerging markets, without having to take the sort of political risk and accounting risk and whatnot.
Most international value managers tend to be underweight Japan, but it's outperformed Europe for the last 4 years. What would turn you to overweight Japan or get equal weight with IPA?
Well, I will tell you, I was the biggest cheerleader for Japan. You can go back. Fortunately or unfortunately, everything I do is public. So you can go back as far back as 2009 and listen to me talk about why we're there, but there are no other value managers there. Stocks are cheap. And the issue is a lot of the things that we liked in the last 4 years, like I own Shimano. Anybody do ride bikes around here? So mostly, I'm sure you know Shimano at least by name. They do bike parts and also fishing reels if you're fisher people. Can't say fishermen. So so that's kind of the type of business we love. Good balance sheet. The management buys back stock. All they've done is stuck with their key business. They've never migrated out of bikes and fishing equipment. The stock was cheap at 3,000. At 20,000, it's not so cheap. And that's exactly what happened. So a lot of our favorite companies doubled, tripled, quadrupled, and quintupled in the span of 4 or 5 years. And so that's kind of why now, starting from scratch, we have maybe 7 or 8%. We're finding things here and there, but it's a lot would need to happen. There are a lot of cigar butts there. It's still the cheapest market in the world in terms of statistically, but I'll give you an example. Some of those, half the market that's not financials, half the market trades for less than book value. So you can make a case that there's some value there. On average, about half that book value is cash. So the other half of the book value has to be worth a lot more to justify a much greater than book value multiple. You can follow it. And a lot of those companies are 4 or 5% return on equity businesses. They're commodity type businesses that that will find it very difficult to earn much higher returns. So, yes, sir.
Yeah, maybe a two-part question. I know that when First Eagle and Manu's you also talked about gold. Maybe talk a little bit about, you touched on it, but kind of the rationale of why you're there, and then maybe weave that into your outlook, I should say, forecast for deflation versus inflation, and then the U.S. dollar strength.
So the gold is there specifically because I don't know what's going to happen in the future. I suspect, I've got my guidelines and my people that I trust and respect and all that whatnot, but ultimately we're trying to think about like the future, and the future is uncertain, it's unknowable, right? In certain states of the world, the gold is the only thing that's going to provide any sort of hedge to whatever the currency is. Typically, gold is a hedge against a currency-related scenario. So for me, it's just another way to diversify our reserves. I have a lot of I have a lot that's not invested in equities or bonds right now, and I don't want to earn 0 or 25 basis points. So some of it is invested in short-term instruments, and some of it a little bit in gold just in case. So that itself is not related to inflation or deflation. For my macro stuff, I kind of rely on other people. It's like my theory with votes. It's always good to have a friend who has a vote. So in my case, I have a friend who's really good at macro. They're called ECRI. It's the Economic Cycle Research Institute, and they're based in New York. What I like about them is they do not start from the point that you can make a point forecast for what's going to happen a year from now, but they give enough information right now to figure out what's going to happen for the next few months. And what I think makes sense, and this is what I'm beginning to see from the bottom up as well, is that there is an inflation cycle already underway, upturn, that, I was on Bloomberg a few months ago, and I was suggesting the Federal, this is before the election, I was suggesting the Federal Reserve was way behind the curve. And I still believe that. So it's a 75 basis, is it 75 basis points now? Yeah, right? I suspect that's going to go higher, and that the market will force them higher. So that, however, that inflationary cycle is in the context of demographic headwinds in the United States, in Western Europe, in China, basically in most, except for India and Mexico and some Latin countries in the Middle East, demographic challenges are immense. And not only is the rate of labor not growing very rapidly, but the rate of people exiting the workforce is starting to go parabolic. So that's, you see these numbers on labor participation and whatnot. Some of that is people leaving the workforce. A lot of people are they're just retiring now. So that, I think, is going to create a pretty major structural headwind long term. But that doesn't mean you can't have, growth cycles and inflation cycles and whatnot. So it's kind of it'll be interesting to see how the market kind of navigates this, because I assume at some point they're going to say that we've escaped and now, everything's great and inflation's the norm again, and that'll probably be the end of the cycle, but who knows when that is. Yes, sir.
Acknowledging that international valuations seem to be better, it's seemed that way for a number of years now. So what do you think is the main catalyst or catalyst for investors to realize that upside?
I think the most likely thing will be just a change in the dollar trend, and that doesn't happen. That doesn't have to happen now or 6 months from now. I don't know when it's going to happen, but that's one of the catalysts. When it does change, though, it'll be a longer-term phenomenon. And then the other thing that I think, especially in the United States, we've sort of downplayed a little bit, but this growth cycle that even before the Trump thing, actually things are starting to improve in this country. I could see even myself walking around. I put this in one of my letters a few months ago, before Trump and all that. As I travel the country to visit, everything from Cleveland to, I was in Columbus and Florida and Birmingham and Chicago and California, and points in between, versus a few years before, things seemed just fine. I mean, people are complaining about shit, but that's normal. But in terms of just activity, business activity, and everything seemed fine to me, which was a very big change a few years ago. So I think underlying conditions have already begun to improve here. And now what's going to surprise people is how they've already begun to also improve, because I've noticed it in Europe already. I'll be going to Asia soon enough. Japan's always kind of like, it's sort of, it's hard. That's our future, Japan, by the way, but they can have a little bit of an upturn as well. So, I mean, you have the chance to have for the first time since before the crisis, a synchronized revival in growth. And this is not like a boom time thing, but that's different than what people are expecting, especially internationally.
Is that what you think will cause the dollar reversal, is that people are overly pessimistic on Europe and
Yeah, because so one reason the dollar is as strong as it is because there's an implicit real interest rate differential between US and foreign interest rates now, especially Europe. And if that were to narrow or even flip, that is, so you have two things that drive currencies. One is what's actually the value of the currency, and then what is right now the interest rate differential. If there's a massive interest rate differential to the benefit of the other currency, even though it's expensive, I'll still buy that currency, right? So that could be one of the, but that's, again, speculation on my part. These are things I suspect, but don't know. Yes, sir.
How do you manage the currency exposure in your strategy?
Well, so we typically are hedged to some degree, about half, acknowledging that we don't know the future, and that over a long period of time, currency just basically washes out. But I'm talking about a long period of time could be 10 years. And so that's not the typical life of an investor in a mutual fund, or one of your clients for that matter. So, which could be maybe closer to 4 years. So for that reason, we've tended to be 50% hedged in the funds, just so they're not subject to an extreme move during the life of the funds. There will be, I will change, in extremes that will be different. 2000, we were essentially completely unhedged because the euro was very, very cheap. Right now, we're not 50, we're 25% hedged. And that's working its way down as the dollar continues to strengthen.
I think one of the keys to international investing is the currency. I think most Americans have very little non-dollar exposure in their portfolio. So to have 10% of their portfolio in non-dollar, reasonably strong currencies makes a great deal of sense. Then to go further and then to try to hedge that. And as you say, in companies like Nestle, what are you hedging? You're hedging a Swiss franc exposure? Well, Nestle's already hedging their exposures. So to me, hedging is not something that the typical U.S. investor should concern themselves a lot with. They should concern themselves with the fact that 100% of the portfolio is invested in one currency, and there's risk in that.
Yeah, well, I actually agree with you. With Nestle, we don't hedge it for that very reason. All these numbers, these are all generalities, and you have to make adjustments for, obviously, the company's own exposures. The companies hedge themselves. You've got to consider that, too. And then, so, yes, and then on the other, should you have any hedge or not? That's a very good point. Academic theory has two answers. One is you want the currency benefits, or the diversification benefits of the foreign currency, so you do not hedge. Or you're a stock picker, and you just want the stock performance, so you 100% hedge. That's the textbook choice. My problem with it is the textbooks don't consider who the actual person is, and that person is not sitting with you for the entire cycle of the 10 years, right? So that's where, to insulate him from an extreme in one way or another it seems to be, that's worked for us, best for us anyway. Ben.
So I know you invest both equity and fixed income. Can you walk through how you make the decision of where you want to be in the cap structure? Is it purely bottom up, or is there top down in that?
So there are really two types of fixed income securities. One is instead of holding cash, I hold short-term bonds that are with some interest rate, 2 years of interest rate risk, but no credit risk. We're earning 2% on that stuff. And then the more interesting stuff is a fixed income, high yield fixed income, which is a part of the overall risk portfolio. So, my objective over time is to generate an equity-like return, but without, with less risk. Whether you define it as this or just, permanent loss of capital. The two are related, ultimately. And so, within the search for equity-like return, sometimes you come across a company that maybe has too much debt for you to narrow down what the intrinsic value of the security is. But in any case, you think the value is worth more, it's more than zero. And if the bonds yield equity-like, which is not that much right now, it's like 7%, with, including our fee, then that's a reasonable, security to consider. So we're just trying to get equity-like returns with very little chance of, ultimately no chance of default on the underlying security. Yeah, so earlier this time last year, there was an abundance of these securities, yielding 10, 12, 15%. Now, those same 10, 12% securities, I keep on getting them called for me. I just got another one called yesterday. So we're not at 20%. I wanted to be 20% in high yield last year, and we got up to about 10 before the market really shot up. And now we're at 5 because everything gets called. That's a big risk with high yield investing, especially the ones that are better businesses that have high yield paper, because the balance sheet's just too heavy on debt. That stuff usually gets called away from you. Yes, sir.
I'm a speculator, investor. I guess looking at your performance, I'm trying to understand, like we have a partner who's a very deep value-oriented investor. It seems like the last 6 months, last quarter of last year, values took off and we had a huge differential, 18 to negative 3% between our two portfolios. But it seems like, I don't know if it's the asset, multi-asset profile that you have or that it's the goal or whatever, but it seems like you guys actually underperformed during that period.
Which period? 6 months?
Like the last 6 months,
Oh.
last quarter.
Yeah, it's just such a short
I know.
look, but
I'm just trying to understand the risk profile.
so we are much more geared towards international, which means we're going to have an international massively lagged over the last time period we're talking about. So that's probably one reason. The dollar's also continue to strengthen. We're hedged a little bit, obviously, but not fully, or we're not fully exposed. Yeah, I don't know. We haven't really done an attribution analysis. That's not unusual. Like the last part of 14, we also had one of those kind of wobbles.
I think that's international value. Very important. So he's got the international value. I think there may be a difference in comparison between the investors fund, the allocation fund, versus
That's what I figured.
actual international fund, which is, if you want to go through the difference between two funds, maybe.
Sure, I was just told not to talk too much about
No.
But, I mean,
Do whatever you want.
I think that's a difference.
Okay.
Don't do
all right,
anything.
so the difference is the average allocation, or in that category that we're, it's like something allocation. They have, I think, about a third more exposure to the United States, consequently a third less to international. That would probably explain the bulk of it, probably 80–90% of it. The other is we, in value, so I'm not sure if I totally agree that value has been doing well. I think what's happened is banks have been doing well and commodity companies have been doing well. Really just those two. Everything, and we don't really own much of those historically and prospectively. So, that's, I've told people, that tactical stuff, I think what I do works over a period of time, long period of time, but, obviously in the short term, you're dealing with tactical moves in different asset classes and whatnot. We're a core fund. It's that tactical stuff you need to put around us if you want to play with that. But it's like my money in the fund. I just don't play with it. It was funny. Like the first 3 months. Now here's another answer for you because I got them off. The first 3 months, it was in the top like 5% or something, right? You thought, oh yeah, we're the best. And then the last for the 3 months, I think it's been the bottom, whatever it is. Right? But we just kind of done this. It's everyone else is Brexit, Trump. And we're just sort of like doing that. It just evens out over time. Yes, sir.
So there's a lot of talk about protectionism these days, and it's been geared a lot at China and Mexico, and I think a lot of that has to do with the massive trade deficits that the U.S. has with those countries. One, would you agree with that? And two, do you see any other countries internationally that would be negatively impacted by all this protectionism that could potentially come in the next 4 years?
Well, there's not really there's not much of a trade deficit with Mexico.
Well, I'm just saying, like, relative to every other country that the U.S. trades with.
Yeah, there still isn't much of a trade deficit with Mexico. It's with China, that's the problem. That's probably 80% of the problem is China, 20% was oil, and that's kind of diminishing. And then we have a trade deficit with basically every other country in the world. I mean, it's not just those two. The big one is China. I think that so conventional wisdom has settled on China's entry into the WTO in 2001 as the starting gun for that sucking sound of manufacturing out of the United States. And it's obviously coincident, and it's hard to disagree with it, right? But I think what people need to understand is that company FANUC that I mentioned is probably equally responsible for taking jobs and creating the manufacturing kind of bust that we've seen here. So bringing back manufacturing is not bringing back jobs, right? So then it just becomes what's really the relationship? What are we selling to them versus them buying from us? And that's a negotiation, But if conventional wisdom holds, however, they're going to do stupid things. Eventually, someone's going to do the math, though, and figure out where's the actual deficit coming from. And beyond that, what is it you think you can do about it? Other than just put up tariffs and whatnot. And I think differently than we're blessed because this country is because it has a service-oriented economy. There is so much manufacturing overcapacity outside the United States, and they're all trying to compete for diminishing demand for manufactured goods, that there's a massive amount of deflation as a result in many of these countries, structurally, because of that. And how they're responding to it, they're investing themselves in robotics. There are probably going to be 1 million+ robots in the world within a year or two. That's where the jobs are done. Even in China, that's where the jobs are going to start going. The bigger threat really is, we kind of went through it already. The bigger threat really is to a lot of emerging markets that have, robotics or labor that's cheap, like Mexico, where, however, the robotic cost per hour is equal now to the minimum wage in most of those maquiladoras, $5 an hour. And they work 24 hours without complaint. So I think there's a bigger threat, but it's not here. It's actually going to emerge. Actually, as much as telecom leaped in some emerging markets they didn't even go to fixed line; they just went straight to wireless. There could be that kind of technological leap that really just displaces a massive amount of manufacturing people. But yeah, it's a problem. I mean, they're making it a problem.
When you talk about your long-term horizon, frame that in terms of portfolio turnover, length of holding for a given issue, or your target holding period when you enter the position in.
Historically, turnover has been about somewhere between 10 and 20%. We tell people 25%, but you mentioned Nestle. I've owned that since 2002. Between the two places. Berkshire Hathaway was the first thing I ever bought from my old First Eagle funds in 2000. February 2000, I bought it at $41,000 a share. They still own it. That said, there are certain types of businesses, those cigar butts, that you just get out of when you get to intrinsic value, because the intrinsic value is not going to grow. So if you have those Buffett-type compound kind of companies, you tend to just hold on to those. Even if they're kind of overvalued, eventually the value catches up to the price. So I suspect it'll be less than 25% in the equity portfolio. Well, thank you again for skipping Trump's press speech.